You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host, Sam Ball. This week on The Investor Way, we have Nestle, ASOS, Dunelm, Money Supermarket, AJ Bell, and our US company of the week is Shopify. Sam, should I get us kicked off with Nestle? Another favourite of the show.
You beat me to it.
It's the Swiss consumer goods company that owns brands from Nespresso to Kit Kat, and they had their third quarter results out last week with 9-month organic sales growth of 8.5% to 69.1 billion Swiss francs, with higher prices contributing 7.5% and volumes rising 1%. Breaking those results down, North America saw sales growth of 11.2% to 19.1 billion Swiss francs, driven almost completely by price rises. There was a strong performance in e-commerce and recovery in off-trade, with Nestle continuing to gain market share, helped by pet food and coffee. In Europe, sales growth came in at 7.1% at 14 billion Swiss francs. Pricing alongside recovery in off-trade helped drive growth. There were market share gains in coffee, infant nutrition, and plant-based foods. In Asia, Oceania, and Africa, sales grew 8.1% to 13.9 billion Swiss francs, with pricing and recovery in off-trade. There were market share gains in culinary, ready-to-drink, and portioned coffee, along with infant nutrition. Latin America saw sales growth of 12.9% to 8.6 billion Swiss francs, with pricing and resilient volumes. There were market share gains in infant nutrition, pet food, and coffee creamers. In Greater China, sales grew 4.7% to 3.8 billion Swiss francs, with pricing and volume growth. Nespresso, the designer coffee brand, grew 3% to 4.7 billion Swiss francs, 4.9% coming from pricing, alongside a volume decline of 1.9% on the back of double-digit growth last year. Nestle Health Science saw sales growth of 3% to 4.8 billion Swiss francs, with acquisitions pushing sales up 42.5%, with the Bountiful Company and Orgain. The group now expects full-year organic sales growth of around 8%, with an underlying operating profit margin of 17%. In terms of valuation, Nestle has a market cap of 294 billion Swiss francs and trades at 21.5 times forward earnings, compared with a 10-year average of 21.2, and has a prospective dividend yield of 2.9%. I thought these were really good results in the current environment, with volumes actually up alongside the price raises of 7.5%. And it's also, I think it'll also be interesting to see how the Bountiful Company, which specialises in nutrition and supplements, contributes to the growth over the longer term. I mean, inflation is likely to be a struggle, but with brands as strong as Nestle, I don't think it's going to have too much difficulty and continuing with its steady growth. Extremely high quality that I like, certainly not cheap, but it would be one that I'd consider as part of the buy and hold very long-term strategy. And it's up there with other quality companies like Louis Vuitton that we covered last week and Unilever, but I'd say it's probably a step above Unilever, and the numbers that it's been delivering over the last couple of years are certainly ahead, again, reflected in that valuation. Sam, what are your thoughts on this update?
It was very good, actually. The price rises we are used to seeing, but the volume increase, I think, is really impressive in the current environment. And it's not something that we have seen from Unilever, which is reflected in the difference between the PE ratios. But I think at 21.5 compared to a 10-year average of 21.2, it's about in line. The dividend yield's almost 3% now. It's still not cheap, but it's starting to look more attractive. And as well, I think the operating margin of 17%, I think that's very impressive too. I think that's what Unilever's were at one point before they started sliding, but that's just from memory. I think it's a fantastic business. volume increase is really impressive in this environment. And I think the price is starting to look more reasonable. It's just a very, very good business, and I do really admire it.
Yeah. And it is one that you'd be able to sleep easily with at night, which there's a lot to be said for.
Yes, absolutely.
Okay. Right. On to one that you probably can't sleep well with, ASOS.
Yes, ASOS, the online fashion brand, have come out with their full year results, and sales for the year rose 4% to £3.9 billion, excluding Russian operations and the impact of exchange rates. Growth was supported by the UK and US, which offset declines in the rest of the world. Growth in the second half was lower than expected as inflationary pressures weighed on consumer spending. Underlying profit before tax of £22 million was in line with guidance and down from £193.6 million the previous year. Speaking to the 2023 financial year, the group sees significant volatility in the wider environment, making it very difficult to predict consumer demand. Sales in the UK rose 7% to £1.8 billion as demand shifted to occasion wear, supporting average selling price growth. Growth was partly offset by higher return rates as consumers faced increasing pressure over the period and discounting ramps up. In the EU, sales grew 2% to £1.2 billion as the region became increasingly exposed to higher energy costs and inflationary pressures. The region also saw a step up in return rates, trending above pre-pandemic levels. US sales grew 10% to $531.4 million, supported by Topshop and Topman growth, the expansion of wholesale and a more locally relevant offer. Customer acquisition slowed in the second half as ASOS paused its broad reach marketing campaign in response to economic conditions. Rest of the world sales declined by 9% to $472.3 million, impacted by continued delivery disruptions in the first part of the year. ASOS saw a free cash outflow of $303.3 million, which contributed to a net debt position of $152.9 million compared to net cash the previous year of $199.5 million. New CEO, Jose Antonio Ramos Calamonte, has laid out a 12-month plan focused on delivering key operational improvements and disciplined capital allocation aimed at increasing gross margins. The group is expecting to return to cash generation in the second half of the new financial year, with lower costs expected to offset inflationary headwinds and higher return rates. In terms of the valuation, the business now trades at a forward PE ratio of 10.3, and that compares to a 10-year average of 50.8, and it doesn't currently pay a dividend. We've covered ASOS multiple times on the show, along with Boohoo. We're also both shareholders in Boohoo. My initial reaction was that I prefer Boohoo as a company. I prefer Boohoo's track record, but I thought these were slightly better results. The last time we looked at Boohoo, admittedly, it was only the 6-month results to 31 August, but sales had actually declined slightly, whereas at least they're still increasing at ASOS. So my thought was, well, maybe we'd have been better off if we'd got ASOS instead of Boohoo. And I had a look at the share price, and we actually wouldn't. We would have been worse off. So at the minute, Boohoo is, let's see, down 80% over 5 years, 81% over 1 year, and 50% over 6 months. Whereas ASOS is down 90% over 5 years, 81% over 1 year, and 60% over 6 months. So we are 10% better off than we would have been. I do like ASOS and Boohoo. I think they're both very, very depressed valuations due to what I think are temporary problems. And we've seen a similar thing with ASOS to what we saw with Boohoo. Yeah, I don't see anything to suggest they won't get back to growth. They won't get back to previous profitability levels. We could just be wrong, but I think the market's short-sighted. And I think at 10 times earnings, and that's 10 times forward earnings, and that's heavily reduced forward earnings, I think it's very attractive. But of the two, I'm quite happy holding Boohoo, and I certainly don't want to add another one. So, John, what are your thoughts on these results and how the valuation compares to Boohoo?
So I think the results they weren't fantastic. They were better than expected, and they were better than the most recent Boohoo results. I still believe in both of the companies, prefer Boohoo. And I think also with the macro picture changing, Boohoo probably is a slightly lower price point. And from memory, in fact, I can't remember the stat, but it does manufacture significantly more product itself and has higher margins on those products. So I probably do still prefer Boohoo, but it is the long-term view. And you would expect, particularly given how highly rated these stocks were, if anything went sort of wrong in terms of the growth and the slowing of the growth, you did expect them to come sort of crashing down. And I think we bought Boohoo at about 17 times earnings and thought it was actually, a good quality business at that price. We liked it when it was sort of 30 or 40 times earnings, but it was just paying up for that we weren't prepared to do. As we've seen, it has fallen further, and you could never time buying any shares. But the market isn't always looking to the very long term. And it's much easier if you are an investor rather than the trader, because that's what you're doing. You are looking for the very long term. And I think the fundamentals in the long term are good for both businesses. So it's going to be a bumpy ride for sure going forward. We hope that they get back on track when the macro picture improves sooner rather than later. But it doesn't look like either of these companies are going to be going bust anytime soon. And I think if you're prepared to hold on, I hope you will be rewarded, or we will be rewarded. So yeah, I'm happy holding, not checking the share price too regularly, and yeah, keeping a track of what's going on with the trading updates.
Yeah, I'd echo that. I think with both ASOS and Boohoo, I think if I look forward 5 years, I think they're both still around, and I think they're both significantly bigger than where they are. And a lot of the problems they're both facing, a lot of it's to do with supply chains, inflation. It's a lot of stuff like that, and it's very temporary problems. Like we've had it when we've looked at the Boohoo statements where they can't even meet demand in the US, and it's a problem, but it is a nice problem in a way, because once those supply problems are sorted out, they can just go back into growth. I think for ASOS and Boohoo, the potential size of the US market is very exciting if they can do that profitably. We've got a lot of UK players that are actually trying to crack the US. So we've got ASOS, Boohoo, Associated British Foods, which have Primark. Primark are now starting to expand in the US. But when you look at the results, US sales 530 million compared to 1.8 billion in the UK. And the US is a much bigger market. So if they can carry on growing, if they can take that growth they've had in the UK over to the US, they'll do very well.
Yeah. And it's probably worth saying as well that the king of the high street, or the king of retail, Mike Ashley, is building a position in ASOS at the moment.
There you go.
Whether that's a good or a bad thing, I don't know, but he is.
Well, he's a man who likes a bargain, so make of that what you will.
It's certainly cheap, yeah.
Shall we move on to another high street retailer then?
Yes, so probably a favourite of the show as well, Dunelm, the FTSE 250 furniture and homewares business, had their first quarter trading update out last week, with sales for the 13 weeks to the 1st of October falling 8% to £357 million, but still 36% ahead of pre-pandemic levels. Digital sales, including click and collect, were flat at 33% of sales, but remain 14% ahead of 2019 levels. Both these being in line with expectations. On the outlook, the group explained, the macroeconomic environment remains challenging, and our primary focus is on continuing to offer outstanding value and choice to all our customers across a broad range of homewares products. We have a strong business model. Our focus on mitigating external headwinds whilst making decisions for the long term is helping us to navigate the current inflationary challenges. Whilst exchange rate movements have been particularly volatile in recent weeks, we are very well hedged for the remainder of full year 2023. We are confident in the resilience of our business, and our guidance for full year 2023 is unchanged from the preliminary results announcement last month. In terms of valuation, Dunelm has a market cap of £1.7 billion and trades at 9.5 times earnings, with a dividend yield of around 3%. I thought these results, they were up against strong comparators. I think given where we are in the cycle, they were decent. I think going forward, certainly the discretionary consumer spending is going to be under pressure, and there is inflation to deal with. I still think the business is well run and quality. Perhaps as it is at the lower sort of mid end, I think it'll probably be okay. And it's certainly at the current valuation, it's not expensive. Bumpy ride, I would imagine, but I think there's a lot of value to be had in Dunelm, particularly if you're a US investor looking at potentially undervalued businesses in the UK. Dunelm would be up there amongst the retailers that I'd be sort of looking at, really, and probably adding to the watch list, along with Tesco's. Probably not one for me right now, and I do have significant exposure to retail with both Boohoo and Tesco's, but I do like it overall, and it would be one for the long term. Sam, your thoughts on these results in Dunelm?
I thought they were okay. 36% up against pre-pandemic is still very good. We have seen the house builders now start to drop off slightly, and you would expect Dunelm to follow that to a degree. So it's not too surprising given the current environment. And if you're doing up your home or something like that, in current environment, it's discretionary spending. It is something you can stop if times aren't as good all of a sudden. And that's what people are doing. I think the 33% online sales is good. It would be nice to see them get that further up, ideally towards next levels, but I don't know if their products are the type of thing that you're ever going to have more than 50% online on. If they can get that, that's fantastic. It's the 13 weeks to 1 October. I don't really understand why we covered their results about a month ago. I don't really get why they're coming out with this a month later, because they had most of that information then. I think they could have been a bit clearer when they released the last set of results. So not ideal from management, I think, but I like the valuation. I like the business, and over the long term, I think it's well run. I think it's one of the better high street retailers, and I would probably back it to beat the market. I do think it's a well run business at a good valuation.
Yeah, one for the watch list.
Yeah, I think it is good enough for the watch list. I don't know if I'd have it over something like Next, though. If I was to add a retailer, I would go for Next. I think that's the best business on the high street, probably.
Yeah.
But Dunelm, if I was making a basket of UK high street stocks, quality high street stocks, Dunelm would be in the basket.
Yeah. Okay, on to our next company.
Yes, so our next company is Money Supermarket, the price comparison website, and they have come out with a trading statement for the third quarter. And for the 3 months ended 30 September 2022, the insurance division was up 10% to 45 million. The money division was up 42% to 28 million. Home services was down 26% to 10.3 million. And that includes the energy comparison. Travel was up 204% to 4.5 million, but that's still only about 5% of the business. Cashback is 13.7 million, but that's new from an acquisition they did earlier in the year. And for the 9 months ended 30 September 2022, insurance was up 8% to 131 million. Money was up 47% to 81 million. Home services was down 51% to 29 million. Travel was up 402% to 12 million. And cashback is 41 million. And again, that doesn't have a comparative. So revenue in the quarter, excluding cashback, grew 15%, which was driven by strong growth in money and travel channels. In insurance, travel insurance growth was moderated, but was still strong, with revenue around 15% higher than 2019 levels. The group was partially offset by car and home, although market switching volume did improve to single-digit declines compared to the double-digit declines seen in the first half. Premium inflation accelerated in Q3, which drove higher search volumes. There was continued strong growth in all channels in money, with particularly attractive products available in banking. In home services, broadband and mobile saw good growth. September marked the anniversary of the closure of the energy switching market, The conditions in the wholesale energy market and the introduction of government support measures, including the energy price guarantee, mean it is unlikely that energy switching will return in 2023. So these results are a week old, so I don't know what's going on with the energy price guarantee now.
Yeah, I think well, does anyone know? I think now it is only for 6 months.
Right,
and
okay.
We don't know after that, but it's at the moment, as we record, it's just for 6 months.
Yeah, you don't expect it to become dated that quickly, but these results are 7 days old. So anything to do with energy, or anything that may be impacted by government policy, do take with a pinch of salt. Well, we did what business was it? We did a business like 1 or 2 weeks ago, and we talked about how they'd be like 100 million better off with the corporation tax not going up.
Yeah,
and I remember making a joke if we don't get a U-turn on it, and the U-turn was literally the next day. Yeah. But anyway, whilst delivering significant year-on-year growth, travel weakened during the quarter as consumer sentiment softened demand. Revenue was around half of pre-pandemic levels. Consistent with the first half, cashback benefited from recovery in travel, offset by lower volumes in other channels. In the outlook, they've said our Q3 performance was ahead of expectations, particularly in money. Factors affecting our performance for 2022 are unchanged from those outlined in our interim results in July. The board expects full-year EBITDA to be towards the upper end of market expectations. Peter Duffy, CEO, said the cost of living crisis makes our purpose of helping households save money as important as ever. This quarter was another good performance. There are early signs of improving trends in the insurance market, and in money, more consumers are finding attractive products to switch to. Our strong brands are well equipped to support consumers at this critical time. In terms of the valuation, the business is trading at a PE ratio of 14.5, and it currently yields 6.5%. I like the business. I was a shareholder until very recently, and the only reason I sold it was because I wanted to buy Supreme instead, and something had to go. One thing I do like about it is I think it's down about a third over the past couple of years. That's mainly due to the loss of the energy switching division, which has basically been destroyed. But it shows what a well-diversified business it is, because although it's lost some of the revenue, it's now at 14.5 times earnings. And it's basically, I think, priced as if the energy segment isn't coming back. It's still got a diversified income stream. It's got the new cashback division too. It's got a very attractive dividend, which they've said they think they'll be able to maintain. And I think when energy does come back, it's probably not going to be 2023, but 2024, 2025, when that does come back, it's going to be looking very, very cheap, very, very quickly. And even if it doesn't come back, I like the divisions it's got. I like the business as it is, and I would still back it to continue growing. So, and I've not worked it out for these results, but last time we did it, we worked out the return on capital. It's insanely high for this business. The only issue this business has is it can't reinvest all the cash it generates, which is why the dividend's so high. But I really like it. I thought these were very good results. There's what you're now seeing, because energy switching's been obliterated, that's now starting to come out of the comparatives. But I thought revenue growth of 15% was pretty good. So yeah, I like it, and I like the valuation. John, what are your thoughts?
I thought they were very good results. And I think, you hear Martin Lewis a lot on the radio now. He's on the TV here in the UK, and switching for everything, with the exception of energy. And I appreciate that was a massive area for Money Supermarket, is back. And I suppose that's really, with the cost of living, people are looking to have more competitive, switch and save money, essentially. Also, you see rising interest rates, and previously there wasn't much that was attractive. You didn't get any return on deposit. Now you've got new deals every day. So people are going on to Money Supermarket and comparing, and you're seeing that in the numbers. Also, travel, certainly compared with 2021, where there was still a lot of disruption with COVID, is back. And I think probably in the longer term, energy clearly doesn't work. Whether we'll go back to what we had before, I doubt it. And that was just everybody was switching, and there were some very suspect energy retailers, which have all subsequently gone bust. But I would imagine that this price cap, obviously it can't continue forever. We go back to something that's a bit more free market, and Money Supermarket again would come into its own. That's certainly not priced in at the moment, I don't think. So, and like you say, the return on capital employed is very high with Money Supermarket. What did you say the valuation was at the moment?
14.5 times earnings, 6.5% yield.
Yeah, it's not expensive.
No.
So yeah, I do like it. I mean, I think we're looking at a lot of UK stocks, and there's a lot that's really decent and is not expensive. I think particularly, I mean, it's obviously good if you're a UK investor, but if you're an American investor, like some of the stocks you can get in the UK are so cheap, and when you've got that dollar. Sad that we just have the pound and it doesn't go quite as far. But I think there are some, it's a stock pickers market and some great companies out there at the moment.
Should we move on to, is it a great company or not? I don't know. We've covered it a few times and never quite decided.
Yeah, AJ Bell. I mean, you like you like Hargreaves.
I like the industry more than I like AJ Bell, I'd say.
Okay, fine. So AJ Bell is the UK's second biggest DIY stockbroking platform, listed on the FTSE 250. They had their year-end trading update out last week. In the platform business, customer numbers were up 16% to 425,652, with total advised customers growing 15% to 145,371, and the direct to consumers up 16% at 280,281 customers. Assets under administration were down 2% at £64.1 billion, with strong net inflows in the year offset by adverse market movements of 11%. During the year, the FTSE All-Share Index was down 7% and the FTSE 250 was down 25%. The group highlights that gross and net inflows were resilient against the volatile market backdrop, and whilst this is lower than the very strong prior year comparatives, gross inflows were 36% higher and net inflows were 18% higher than those achieved in full year 2020. Gross inflows for the year totaled £10.1 billion, compared with £10.9 billion in full year 2021 and £7.4 billion in full year 2020. Net inflows in the year totaled £5.8 billion, compared with £7 billion in full year 2021 and £4.9 billion in full year 2020. In the AJ Bell Investments business, assets under management increased 27% to £2.8 billion, and underlying net inflows grew 14% to £1.05 billion. And all of AJ Bell's multi-asset funds have outperformed their investment association sector benchmarks over 1, 3 and 5 years to the 30th of September 2022. In the non-platform business, customer numbers increased by 1% to 14,937. Net outflows in the year came in at £2 billion, following the previous reported closure of AJ Bell's institutional stockbroking business. In terms of valuation, AJ Bell has a market cap of £1.3 billion, and as of the last results, trades at 35 times earnings. I mean, I thought these results they were a lot better than I was expecting. I'm not that keen on the business model. Same with Hargreaves Lansdown. I think there's a lot of commoditization in it, race to the bottom with the lower fees and more players penetrating the market and just driving it ever lower. I'd also be worried that there are going to be fewer people investing with a turn in the macro environment, having less money to spend and less money to invest. And I'd expect that to feed through at some point with AJ Bell. But for the first reason, that it's more of a commodity, I'm not keen on it as an investment. And I certainly don't think it's cheap at 35 times earnings. I appreciate that could come down, but it's still pretty pricey. So yeah, I'm just not keen, although I don't think these were particularly bad results. Sam, you own Hargreaves Lansdown and you're a bit more bullish on the sector. What were your thoughts on these results, and how do you see the sector going forward?
I thought these results were actually pretty decent. So I thought customers increasing about 15%. It's all right. It's definitely nowhere near what it should be, given the valuation it trades at, but it's a decent number. I appreciate they're going to take on more customers when the market goes up and less when the market goes down, and it's been a year where the market goes down. The figure I always pay the most attention to with these is assets under administration, and that's closed down 2% at 64 billion. I think that's pretty good because they've had to offset the market decreasing 11%. So I think that's actually all right. If they can tread water in terms of the assets they manage in a year when the market's down, that's pretty good because that's the figure they're going to be monetizing. We're starting to see interest rates creep up, so they're going to get higher revenue on the cash. So that again should start to feed through into increased earnings.
On that point, though, do you think that fewer people, because they're going to get a positive return on their cash, are going to leave it in cash and go onto Money Supermarket to look for whichever 1 year fixed rate bond is the highest and fix there and get 4 or 5%?
Possibly. I can't speak for AJ Bell, but Hargreaves Lansdown have started doing cash ISAs, so they're in a better position for it. But I just think I covered it every time, but Hargreaves is such a strong business. I know you think it might be get commoditized in the end, but it's an incredibly strong business. It's got about a 40% market share in the direct-to-consumer market. It's a very good platform. It's trading at about 14 times earnings now. It's very, very, and those are on depressed earnings. It's very, very cheap. And in the it did a trading statement. The latest thing we've got is last week it came out, or this week, maybe this week or last, it came out with a trading statement for the quarter ended 30 September. So whereas this covers the year, this is just the quarter. But again, revenue is up 15%. Net new client growth was only 17,000 for the quarter. So that would work out at about 75, 80,000 for the year. So in terms of customers, AJ Bell does seem to be taking some market share. But I think at the higher end of the market, I think people are still using Hargreaves. I think that 1.75 million active clients absolutely dwarfs AJ Bell's 425,000. Yeah, I just think it's a better business. It's a stronger business. It's the market leader. And I think if I'm going to invest in AJ Bell at 5 times earnings over Hargreaves at 14, it needs to be putting up better than 15% customer growth over the year.
What do you think about Hargreaves giving discounts to customers threatening to leave?
I don't really have an issue with it. I think they know the lifetime value of a customer, and their client retention rate is 92.2%. So they are doing anything you hear about customers leaving. That's from the latest trading statement to 30 September. So 92.2% is very, very good. It's actually, I don't think they've included it in their statement, but it's actually lower than AJ Bell's. I think their retention usually hovers around 94, 95%. So Hargreaves is slightly lower, actually. But yeah, the figures just aren't good enough for me to want to buy it over Hargreaves when Hargreaves is so strong.
Yeah, no, fair enough. I mean, you hold it and you like it. Would you, I suppose it's a silly question, you wouldn't be adding AJ Bell to your watch list?
Probably not. If I wanted more, I'd top up Hargreaves before I bought more before I added AJ Bell. I think it's just the better business.
Fine.
Shall we move on to another expensive business then?
Yes. So on to Shopify, our US company of the week.
Yes. So expensive, but cheaper than it used to be. As with
all of the US tech, yeah.
So they have come out with their Q2 results. For anyone who doesn't know what Shopify is, it usually it sits in the background for a lot of businesses. So like Kourtney Kardashian has her makeup business that uses the Shopify platform. This is just from memory. I think Heinz, their direct consumer stuff that uses the Shopify platform. What it is it's basically a business in a box where you go in, you press a few buttons and it does everything for you. It makes the interface very nice. It deals with your payments. Everything you can think of, it's got some kind of widget. It's just very, very easy to use. So They have come out with their second quarter results, and in the second quarter financial highlights, total revenue grew 16% year over year to 1.3 billion, and all these figures are in dollars, which represents a 3-year compound annual growth rate of 53%. Total reported revenue growth year over year was negatively impacted by approximately 1.5 percentage points, given the significant strengthening of the US dollar. Monthly recurring revenue was 107.2 million, which increased 13% year over year as more merchants joined the platform and the number of retail locations using POS Pro increased. Shopify Plus contributed 33.7 million, or 31% of monthly recurring revenue, compared to 26% last year, as larger merchants seek out greater value from their digital platforms. Subscription solutions revenue was 366.4 million, up 10% year over year, primarily due to more merchants joining the platform and reflecting our change in terms to make selling in our app and theme stores free for partners up to their first $1 million annually, terms that were not in place until the third quarter of 2021. Gross merchandise volume for the second quarter was 46.9 billion, which represented a 3-year compound annual growth rate of 50% and an increase of 4.7 billion, or 11% over the second quarter of 2021. Gross payment volume grew to 24.9 billion, which accounted for 53% of gross merchandise volume processed in the quarter, versus 48% in the second quarter of 2021. Merchant solutions revenue was 928.6 million, up 18%, driven primarily by the growth of gross merchandise volume and the continued solid uptake of merchant solutions such as Shopify Payments, Shopify Capital, and Shopify Markets. Gross profit dollars grew 6% to 655.6 million, reflecting primarily a greater mix of lower margin merchant solutions revenue, lower margin in Shopify Payments due to merchant and card mix, and increased investment in our cloud infrastructure. Adjusted operating loss for the second quarter of 2022 was 190.2 million, or 15% of revenue, versus income of 139.4 million, or 12% of revenue a year ago. The net loss for the quarter was 1.2 billion, or 95 cents per basic and diluted share, compared with net income of 0.9 billion, or 69 cents per diluted share last year. At 30 June, Shopify had 6.95 billion in cash equivalents, and marketable securities, compared with 7.77 billion in December. Shopify launched Shopify Audiences, a marketing tool powered by an audience network and machine learning that helps merchants find high-intent buyers for their products. At launch, merchants can sync Shopify Audiences with Facebook and Instagram and are working to extend to platforms such as TikTok, Snap, Pinterest, Microsoft Criteo, and others. Shopify continued to build Shopify Fulfillment Network to offer our merchants and their buyers simple, fast, and affordable fulfillment. We completed the rollout of Shopify's warehouse management system to our fulfillment network and introduced our delivery badge, Shop Promise, into early access, which will enable merchants to offer buyers visibility into when they will receive their orders. Shopify launched our integrated hardware with payments to retail merchants in Italy in June and Singapore in July, bringing the total number of countries in which Shopify POS hardware is available to 13. So POS will be point of sale, I think. Shopify launched Shopify Payments in France, expanding the availability of Shopify Payments to 18 countries. Shopify closed its acquisition of e-commerce fulfillment technology company Deliver, with 2 R's, on July 8th. The addition of Deliver's world-class software, talent, data, scale, Shopify Fulfillment Network will offer merchants a one-stop shop for their logistics needs, from initial receipt of inventory to smart distribution through to fast delivery and easy returns. Shopify partnered with YouTube to launch YouTube Shopping, enabling Shopify's millions of merchants around the world to reach YouTube's over 2 billion monthly logged-in users. With the launch of YouTube Shopping on Shopify, merchants can easily integrate products from their online store into live streams, videos, and into a new store tab on their YouTube channel to feature their entire selection of products. As e-commerce has reverted to a level slightly higher than its pre-COVID trend, in an effort to recalibrate our operation, Shopify took steps to streamline its workforce in July, reducing its total headcount by approximately 10%. We've grown our adjusted operating income for the past 5 years through 2021. We now expect 2022 will end up being different, more of a transition year in which e-commerce has largely reset to the pre-COVID trend line and is now pressured by persistent high inflation. We expect our multi-channel superpowers and strong valuation proposition will continue to help our merchants in this environment. We are excited about our critical investments like Deliver that we believe will position us well for the future of commerce. Our financial outlook for the rest of 2022, which includes the impact of Deliver and our new compensation system that we expect to implement in our third quarter, assumes that higher inflation will persist for the foreseeable future and combined with rising interest rates will pressure consumers' wallets for purchases of goods. For 2022, we expect gross merchandise volume growth, though impacted by persistent inflation, will continue to outperform the broader retail market in the second half. Merchant Solutions revenue will continue to grow as a percentage of gross merchandise volume, driven by Shopify Payments, Capital Markets, ShopPay Installments, and Shopify Fulfillment, including Deliver. The number of new merchants joining the platform in the second half will be higher than in the first half as our localized subscription pricing and other commercial initiatives gain traction. Merchant Solutions revenue year over year will be more than double that of Subscription Solutions growth for full year 2022. Both gross merchandise volume and total revenue in 2022 will be more evenly distributed across the 4 quarters, similar to 2021, given the increasing pressure on consumer spending on goods and currency headwinds from the stronger US dollar we're expecting in the back half of the year. Because of this larger mix of Merchant Solutions contributing to overall revenue and Deliver, which we expect to be dilutive, gross profit dollar growth will trail revenue growth, and operating expense growth, excluding one-time items, to meaningfully decelerate year over year in the third quarter and again in the fourth quarter. Factoring in these expectations, we expect to generate an adjusted operating loss for the second half, with our third quarter adjusted operating loss, excluding severance costs, expected to be materially increased over the second quarter, reflecting time needed for the streamlining of our operations to take effect, the implementation of our new compensation framework, first quarter of Deliver, including approximately 450 team members and related integration costs, and up to an estimated 50 million for certain other operating items associated with these areas. As we decelerate operating expense growth into the fourth quarter and with its highest seasonal gross merchandise volume and revenue, we expect adjusted operating loss in the fourth quarter that's significantly smaller than the third quarter but larger than the second. In terms of the valuation, it has a market cap of $38 billion and a share price of $29.27, and that's down from a high of $152, so it's down over 80%. The PE showing us 230 on trailing 12 months, but that's going to go negative as the losses start increasing quarter to quarter. Price to sales is 7.6 and the price to gross profit is 14.65. The financials for the last 4 years are, well, sensational. So compared to calendar year 2018, trailing 12 months, revenue's up 5x, gross profit's up 5x as well. Very, very impressive growth, very, very impressive business, really impressive products as well, actually. I think at a price to gross profit of 14.65, if you think it's still got a lot of growth left in it and you think it will eventually enjoy very high margins, it's a very cheap business, I think. The issue is if they're going out and pumping money into logistics and delivery and trying to compete with Amazon on this, if that massively brings down the margins, even if it gets a lot of growth, if those margins aren't there at the end, it's quite expensive. If this is going to have a 2 to 3% net profit margin, it's a very expensive business. If it's going to have a 30% net profit margin and revenue is still going to 5x from here, it's a fantastic investment. So it depends on what your view is on the delivery and the fulfillment side of the business, how profitable that will be, and also how profitable it will enable the rest of the business to be. Or is it... My concern is if it's a business that's kind of like Amazon, but without... Not like Amazon, but in terms of the profitability, it's got Amazon-like margins, but without Amazon Web Services making all the profits, it's possibly not as impressive as people think it is, or not as low valued as people think it is. And I just find that really difficult to assess. I do like the business. It's very strong results. It's probably a business I'd be interested in coming back to, but at the minute, I just don't feel like I understand it well enough to be able to make that assessment that I was talking about. John, what are your thoughts on the results and the valuation?
It's not the business that I would typically be drawn to. I think historically the performance is really impressive, that the growth that it's delivered. I appreciate now it's a loss, and if you look at the price of sales, it's much cheaper than it has been previously. But I would be very uncertain about that competition with Amazon and the delivery and fulfillment side of the business. And I think with all of those uncertainties, it would just be one that I wouldn't touch. That's not to say it won't be very, very successful, and I could be very, very wrong, but it just wouldn't be a risk that I would be taking.
Yeah. And it's not to say the delivery and fulfillment can't be a home run.
No.
But it's very difficult to assess. And my concern is, and I think it's something that Luke Hallard talked about on his interview, but is it something that they're doing because it's a really great opportunity, or is it something that they're doing because they need to be doing because Amazon's created this expectation of how quickly things need to be delivered, and they just have to take the hit on it whether they like it or not? And depending on the answer to that, fundamentally affects the business. And also, you can't just look at the 80% share price drop. I mean, firstly, it was incredibly highly valued before it dropped 80%. But if you look at the 80% share price drop and think, well, if it goes back up, if it does go back up, it's going to be in 5 years' time, it's going to be a fundamentally different business than it was 5 years ago, because it's going all in on that logistics side.
Yeah. Yeah.
So of the 6 businesses we've talked about today, Nestle, ASOS, Dunelm, Money Supermarket, AJ Bell and Shopify, if you had to buy one, which one would it be?
Ooh, it's quite difficult actually this week. I like Nestle a lot, but I appreciate you'd really be paying up for it. I think with the opportunities ahead and at the current price, I'd probably go for Money Supermarket.
I thought you'd say Nestle. I was also torn between Nestle and Money Supermarket, despite the fact I just sold Money Supermarket. I would probably go with that, which maybe tells me something.
Yeah. Are you happy with Supreme though?
Well, no, it's down about 20%, I think. I've not looked at it for a few weeks, but it was down about 20% when I last looked. But I wouldn't be against getting back into Money Supermarket in the future. I did want Supreme, and something had to be sold. So ideally the price won't budge and I'll be able to buy back in at some point.
Yeah. Okay. Well, thank you again for listening, and we'll see you again next time.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.